Hello everyone, welcome to Tesla Daily News. Today is July 21st, Monday, and the following is the latest Tesla news. According to Nasdaq trading data, Tesla shares closed at $369.57, down from the previous close of $380.84. The stock opened near $386, briefly touched a high around that level, but sold off to finish just above the intraday low, on volume of about 33.8 million shares. Technically, this looks like a bearish reversal day from resistance with rising volume, which short-term traders may read as continued selling pressure after testing the upper range. According to Op Online from Germany, Tesla's factory in Grünheide near Berlin is facing a complex mix of growth plans, political risk, and demand uncertainty that investors should watch closely. The article reports that Tesla manufacturing Brandenburg now plans an annual capacity target of 375,000 vehicles, down from the originally promised 500,000 per year when the plant opened in 2022. In operational terms, that means the factory is currently running at roughly 54% utilization, slightly below the 56% reported for 2024. The piece notes that Tesla presents the new target in its 2025 German financial report as a positive growth story, emphasizing that production is expected to rise in 2026, while largely avoiding direct acknowledgement that the original goal has been scaled back. For equity holders, this matters because it implies that prior long-term volume assumptions for the Berlin plant were too optimistic, which can ripple through margin and cash flow models. According to the same report, Tesla still plans to add about 3,500 jobs in Grünheide and expand its battery cell production. The strategic ambition remains to integrate the entire value chain on site, from battery cells through packs to finished vehicles, and to export from Brandenburg to more than 30 markets. If fully realized, that vertically integrated structure in Europe could be a significant long-term competitive advantage, improving logistics, lowering per-unit costs, and creating a European counterpart to Tesla's EU hubs. However, Op Online emphasizes that Tesla is unusually explicit in identifying geopolitics and policy as key risk factors for this plan. The company states in its German filings that the economic framework in Europe is much less favorable for battery production than in the United States or China, due to higher costs and different incentive structures. It also explicitly ties future investment and expansion of battery manufacturing in Grünheide to political and regulatory developments. For investors, that is a clear signal that European capacity decisions will likely track future subsidy regimes, energy prices, and trade policy. According to the same source, Tesla is currently benefiting from renewed state support for electric vehicles in Germany. The article argues that without these subsidies, demand for the locally produced Model Y would be significantly weaker, even though Model Y was reportedly Europe's best-selling electric vehicle in 2025. The implication is that a meaningful share of Tesla's European volume and pricing power is still dependent on government incentives rather than purely on underlying consumer demand. For shareholders, that makes German and broader EU subsidy policy a direct input into revenue projections. Any tapering of purchase incentives or shifts in eligibility rules could translate into softer order intake, lower factory utilization, or additional discounting to sustain volumes. Conversely, if incentives are extended or strengthened, Tesla could potentially move closer to its revised utilization targets, helping to absorb fixed costs at Grünheide. The Op Online report also highlights a divergence between revenue and profit trends in 2025 for Tesla's German operation. According to the article, annual net profit at Tesla manufacturing Brandenburg increased by about 20 million euros, reaching 77.1 million euros, even though sales fell from roughly 7.7 billion to 7.1 billion euros. Vehicle output was around 202,000 units, about 9,000 fewer than the prior year, which the company attributes to model changes and integration of new variants. For investors, this suggests ongoing cost-down progress in production, consistent with Tesla's global strategy of driving manufacturing efficiency and simplifying variants, even when headline volumes are not growing. Improved profitability at the plant, despite lower revenue and lower output, hints at better cost control, higher yields, or improved product mix. However, low utilization at just over half of installed capacity also means that fixed cost leverage remains under-realized, and incremental volume would have an outsized effect on margins if demand can be stimulated sustainably. The report raises another risk factor that goes beyond pure economics, the reputational and security environment around Grünheide. It notes that Tesla's filings mention possible further attacks on the plant, referencing prior incidents and activist opposition, especially from environmental groups who criticize building such a large factory and battery site in a water protection area. From a risk perspective, sustained activism could generate recurring operational disruptions, regulatory scrutiny, and heightened capex for mitigation measures. The article also underlines a more intangible but still important element for the brand and stock, a stated focus in the German report on building credibility as a prerequisite for business expansion. It notes that Tesla acknowledges that its products and management statements attract substantial public commentary, including, in Tesla's words, exaggerated or unfounded criticism. While the filing does not name Elon Musk directly, the piece argues that his political statements and increasingly right-leaning positions are eroding Tesla's progressive brand appeal among some European buyers. For equity analysts, this translates into brand equity risk and potential demand softness in more liberal markets, especially where EVs are closely associated with environmental and social values. If negative sentiment around the CEO's politics persists, Tesla may be forced to rely more on pricing and incentives rather than pure brand pull to maintain share, especially as European incumbents roll out more competitive EV offerings. Putting this all together, investors should interpret the Grünheide developments as a mixed signal. On one hand, the factory is profitable, vertically integrated, and still expanding its capabilities, which is structurally bullish for Tesla's European cost position. On the other hand, underutilization, dependence on subsidies, explicit policy-linked expansion plans, and reputational headwinds highlight real constraints on unconstrained growth. Scenario analysis around European policy, energy costs, competition from Chinese imports, and Tesla's own brand trajectory will be critical for modeling the medium-term contribution of Berlin to global earnings. According to Pravda in Slovakia, Tesla is also confronting intensifying competitive pressure in one of its most important European markets, Germany. The outlet cites sales data for the first 6 months of 2026 showing that electric vehicle registrations in Germany rose sharply year-on-year, with battery electric, plug-in hybrid, and hybrid vehicles together accounting for nearly a quarter of the market. Although the overall EV segment is expanding, Tesla's relative ranking has slipped. Pravda reports that Volkswagen currently leads the German EV market by brand, followed by Škoda and then BMW. Tesla is listed in 4th position, with an estimated market share of 7.8% in German EV registrations during the first half of the year. This is notable because Tesla previously dominated the German EV landscape, leveraging early mover advantage and the popularity of the Model Y. The same report highlights that Škoda's new Elroq model has taken the top spot as the single best-selling electric vehicle in Germany for the period, with sales of just over 20,000 units. Tesla's Model Y, while still very strong, now ranks second, with about 19,700 units sold over the same period. For investors, the key takeaway is not that Tesla demand has collapsed, but that the competitive set has become more crowded and that European brands are beginning to match or surpass Tesla on value, range, and brand familiarity in their home markets. For Tesla shareholders, Germany's sales hierarchy carries several implications. First, maintaining or rebuilding share will likely require continued price competitiveness, local production advantages from Grünheide, and faster refresh cycles for core models like Model Y. Second, European incumbents are starting to deploy more software-centric architectures and improving charging and infotainment experiences, eroding some of Tesla's historical differentiation. Third, investors should expect that Tesla's European growth may track more closely with overall EV market expansion rather than capturing outsized incremental share, especially if mid-priced crossovers from Volkswagen Group, Stellantis, and Chinese brands continue to proliferate. At the same time, the data from Pravda shows that Germany's EV market is far from saturated, with electric vehicle penetration climbing rapidly despite media narratives about stagnation. That still supports a long runway for volume growth in Europe, even if Tesla's slice of the pie is no longer dominant. For long-term investors, the question becomes whether Tesla can defend margins and brand value in a maturing, more competitive European EV market, or whether it will have to increasingly trade margin for volume. According to reports from Austrian outlets Salzburger Nachrichten, Kronen Zeitung, and the national broadcaster ORF, Tesla continues to show strong brand power in the used electric vehicle market in Austria, even as overall used car prices soften. All three sources rely on data from the online marketplace AutoScout24, which tracks listing prices and search interest. These reports state that prices for used cars in Austria have fallen meaningfully compared with both the beginning of 2026 and the prior year, as supply normalizes after pandemic-era shortages. However, within this broader downtrend, demand for pure battery electric vehicles has risen sharply. AutoScout24 data indicate that user interest in used all-electric cars in June was about 40% higher than at the start of the year, while interest in diesel cars fell by roughly 20% and in gasoline cars by about 15%. The same datasets show that in the Austrian used EV market, European brands collectively account for more than half of total demand on the platform, while Chinese manufacturers represent around 10%. Within the brand ranking, Tesla holds the top position among used EVs, ahead of BMW and Volkswagen. The first Chinese brand in the ranking, BYD, appears only around 6th place. For investors, this matters because the used car market is a key indicator of residual values and long-term brand strength. High interest in used Teslas, even in a falling price environment, suggests that residual values for Tesla vehicles may be more resilient than those of some competitors. Strong residuals typically translate into better leasing economics, lower total cost of ownership for buyers, and a more attractive value proposition, which can support demand for new vehicles as well. The Austrian data also signal that, despite intense price competition and negative headlines around EV price cuts, consumer appetite for electric vehicles in secondary markets is catching up from a low base. As used EVs become cheaper and more widely available, they expand the addressable market to buyers who cannot or will not pay new car prices. Tesla's leadership in this segment positions the brand to benefit from this second-hand diffusion effect, embedding the ecosystem more deeply into European markets. For Tesla enthusiasts, these Austrian findings reinforce that the brand remains aspirational in many parts of Europe, with strong mindshare even when macroeconomic headwinds weigh on overall car spending. For stock investors, this supports the thesis that Tesla's long-term competitive moat includes not just technology and charging networks, but also residual value dynamics that affect lifecycle economics. According to The Conversation in Australia, the rapid growth of electric vehicles in that country is being driven in large part by affordable Chinese-built models, including Teslas assembled in China and exported to Australia. While this article focuses more on policy and data infrastructure than on Tesla's financials, it underscores a structural trend that investors should watch. Australia's EV transition is accelerating, and Tesla is an important part of that story. The Conversation notes that China has become Australia's largest supplier of new vehicles overall, providing an estimated 80% of the country's EVs. Many of these are mass-market models from Chinese brands, but Tesla's vehicles for the Australian market are also predominantly manufactured in China, particularly from the Shanghai Gigafactory. Although Tesla's sales are not included in the local industry association's member reports because the company is not a member, independent data show that Tesla remains one of the leading EV brands in Australia. The article emphasizes that modern EVs, including Teslas, are effectively large, mobile batteries and computers on wheels, with growing potential to interact with the power grid through vehicle-to-grid and vehicle-to-home technologies. For Tesla investors, this aligns with the broader energy ecosystem narrative that the company has been building around Powerwall, Megapack, and software-driven energy management. If Australia improves its data collection on EVs and enables widespread smart charging and bidirectional power flows, Teslas in that market could become valuable distributed energy assets in addition to transportation devices. From a strategic perspective, the Australian discussion highlights how national data policies, grid planning, and cybersecurity regulations will shape the value Tesla can extract from software and energy services layered on top of vehicle sales. The more that countries like Australia treat EVs as grid resources rather than only as cars, the more potential upside exists for recurring revenue from software features, grid services, and energy arbitrage, all areas where Tesla aims to differentiate itself. Taken together, the latest developments present a nuanced picture for Tesla investors and fans. The stock has shown technical weakness after testing higher levels, suggesting near-term volatility. In Europe, the Berlin plant is profitable but underutilized, policy-dependent, and facing tougher competition, even as Tesla maintains a strong position in used EV markets like Austria. In Germany, Model Y is no longer the uncontested leader as rivals like Škoda's Elroq gain traction, underscoring the need for Tesla to keep innovating and adjusting prices. In Australia and other emerging EV markets, Tesla's Chinese-built vehicles are part of a broader electrification wave that could unlock additional value through energy and software integration. Thank you for listening to Tesla Daily News. If you enjoyed this episode or found it helpful for your investing in Tesla knowledge, please consider subscribing and sharing it with other Tesla enthusiasts. Until next time, stay informed and drive safe.